So I'm Daniel Dorfman, one of the co-founders here at REITs, and my background is entirely in real estate investment and in the helping of people buy and sell homes here in Atlanta. And we are really thrilled to be able to be putting this event on for everybody and to have Brian Renshaw, a partner at Moore Colson. I'll let him give a little bio, but an expert in all things REITs, and I'll let him take it away for a second.
Yeah, thanks, Daniel. Brian Renshaw here. Happy to be here. I am a partner at Moore Colson CPAs and Advisors. We specialize in the real estate industry, and I am one of the partners that is in that group, and happy to be here and happy to join Daniel with this presentation.
Perfect. Thanks, Brian. All right, just quick overview of what we're going over today. Here's the agenda. First thing we'll start with is intro into REITs, right? What, why, the hows. Then we'll get into the fundamentals of how they work. Brian will take us through the tax advantages. And then we'll do a REIT comparison, just kind of pulled some of our favorite private REITs to be able to invest into easily and did a side-by-side so people can have that and be able to go off of that. And then, number 5, we did host the webinar, so we will have a slight self-promotion here about why REITs might be a good option for you and talk through a little bit about what makes our fund a little special. And then we will do Q&A. We will try and give as much time as we can to questions and answers. I think that's always the most fun aspect of this presentation and of any of our webinars. So we do try and leave a lot of space for that. And all right, we'll carry on. Cool. So first thing is, what is a REIT? A REIT is the abbreviation for Real Estate Investment Trust. That basically is a company that owns, operates, or finances the income generating real estate. Fun little facts. Over the last 25 years, REITs have outperformed the market, which is cool. Another fact is that REITs were actually brought into existence during the Eisenhower administration. And the point of that was to be able to give large scale real estate opportunities to the people, right? And to allow everybody to participate in that market, which I thought was pretty cool. Before Googling that, before this webinar, I didn't know that. So take that to the dinner table and to the happy hour next time you're out. All right, let's talk about how it works. Like, how does the function happen? The first step is investment, right? Investors buy shares of the REIT and they become beneficiaries of that rental income, of the potential property value appreciation, of the total value, net asset value of the fund overall. The next step is property acquisition. And I will say that all REITs are not created equal. This isn't exactly like this templated style. This is just the most typical format. And so once you invest, you usually would go into the property acquisition format where the managers are going out and acquiring properties. And then, of course, they need to lease those properties. Your managers of those funds will go and lease and get that income generated. They'll collect all the rents for you, taking the headaches out of residential or real estate ownership. And then they will produce a dividend or distribution typically. Some REITs distribute monthly, some do it quarterly, some do it annually. Really, that's up to the structure. And then the opportunity is usually there for you to reinvest those distributions to allow yourself to grow and expand with the fund. Another little tidbit here, REIT structure requires the owners and managers in the fund to distribute at least 90% of the profits, which is great. It's a good mechanism to make sure that there aren't pools of money being hoarded by the managers. All right, let's talk returns. So REITs are primarily made up of 2 primary components, and those are cash dividends, which we just kind of talked about. That's from the rental income, that's from a property sale, that's from any other income or revenue generated by the company that should be distributed out once it's allocated as profit. The other piece is appreciation. This is the growth of the value of the homes, of the properties, of the fund overall. And typically you'll see participation in both of those. Whoa, pro tip. Thanks, Warren. To accelerate your returns, the reinvesting of distributions is always a key factor, right? That compounding interest happens when you do that. And it's a really nice mechanism. And usually there's some benefits that's provided by the REIT to doing so. All right. This here is, in my opinion, the most important piece of what makes a REIT special. And again, about that large scale real estate, throughout my career, I can't tell you the amount of times that we have helped someone buy their first investment property and they've had to sell it 2 years to 3 years later because the numbers just didn't chalk out where they thought it was. So, imagine owning one investment property, right? And something goes wrong with that property. That could be a sewer line going out. That could be the resident, unfortunately, comes on hard times and can't pay rent. And you have, a year-long process of trying to negotiate what that looks like or fix or repair. And so when something goes wrong and you only own one of it, there's a lot leveraged in that bucket. Now, imagine if you own 100 properties and that one little incident's happening over here. You're diversified. You have this opportunity to be successful in the other properties. And it really kind of allows you to stand on your own. Sorry about that. We had a clicking error. All right. So popularity. Why are these so popular? Why are REITs becoming one of the best mechanisms and viewed as a really good piece to have in your portfolio? These are the key points, right? Income generation. So usually when you invest these days into, that booming tech stock or the up and down crypto stock or wherever you are in, the income generation, there's usually not a coupon or a distribution associated with that any longer. Those have kind of gone away. And so this is a great way to bolster some of that income. Tax advantages, which Brian will cover in a minute. Portfolio diversification, right? Like you don't need to just be in one thing. This gives you the ability to really touch some other assets without having to own your own or have the headaches of debt and all those things that come with typical real estate investment. Access to real estate is a big piece of it, right? I think everybody walks around, looks at these big buildings, looks at homes, watches their Zillow app, watches their home values, whatever it might be. Real estate is pretty sexy. I think there's a whole channel on TV just for watching what people do with their homes and how they rebuild them and flip them and all that good stuff. And the reason why is we love land and we love houses, and real estate's a cool asset to be a part of. Another huge thing with this is retirement planning, right? When you get to that age where you want to retire and you want to be able to be self-sustaining off of what you've built, having the component of distributions in that is going to help significantly. And so we see a ton of IRA investment into the fund, IRA investment into REITs. And a big component of that is let's start stockpiling your assets and putting some money into places that's going to work for you, more than a value approach, but as a whole in terms of income when you get ready to park up to put the keys away on the work life. So perfect. All right, Brian, I'm going to pass it to you for tax advantages.
Absolutely. Thank you, Daniel. And some of the things that Daniel's touched on, I'll delve in a little bit deeper. And, I think, there's a lot of advantages from a tax perspective to owning, REIT stocks and so forth. One of the things that we talk about a lot is no double taxation. Typically C corps will pay income tax and then subsequently, then they'll maybe make distributions or dividends after they've already paid taxes. So with REITs, they're not subject, or typically not subject to corporate income tax structure. So that's one of the big advantages. So no double taxation, meaning a C corp tax and then you personally getting taxed. So that's something to note. And then Daniel touched on this earlier, but the 90% rule, what that is in order for REITs to not be taxable, they have to meet certain criteria, one of which is that for their taxable income, they are required by law to distribute at least 90% of their taxable income as dividends to shareholders, which is a big key and one of the reasons they're not subject to tax through the double taxation item I just spoke about earlier. Another really great benefit and somewhat of a more recent benefit that came about through the Tax Cuts and Jobs Act was this item called qualified business income deduction. And what that is it allows shareholders to actually deduct 20% of the ordinary REIT dividends. So you basically, instead of paying tax on 100% of the dividends, you're paying tax on 80% of the dividends. So you're already getting a 20% discount on your tax liability associated with REITs. And that really doesn't have any restriction at the higher taxable income level. So that it really provides a great benefit for those that are invested, especially if you have higher wage earners and so forth. And then lastly, capital gains treatment. What that is capital, there's ordinary income and then there's capital gains income. And capital gains income is less than the capital gains tax rates is less than the ordinary income rate. So what real estate sales and sale of REIT stock are actually long-term capital gains treatment versus ordinary income treatment, which is also a tax savings because ordinary income could be, upwards to 38%. And then, capital gains treatment, depending on your situation, could be 0, 15, or 20%. So there again, you've got a discount of what you're actually paying from a liability perspective. And then if there are return of capital distributions, meaning amounts that you invested that are considered return of capital, those are actually tax-free. So there again, a lot of opportunities from a tax perspective that make REITs, as Daniel calls them, sexy, or real estate sexy. So they're a great investment option as you look to diversify your portfolio. And that really leads into this next slide is, what are your, you really need to take a look at what are your investment objectives? What's your risk tolerance? Not all REITs are the same. Some, invest in specific asset classes, some diversify across asset classes, some are focused on certain geographic areas, some diversify across different areas. So the key here, and Daniel mentioned it earlier, is make sure you're diversified in your investments. And then, REITs are just by their nature are somewhat diversified within themselves. So it's, always taking the approach of never putting all your eggs in one basket. And, that becomes critically important if you're invested in one stock. And, that's why mutual funds became very, great investments over time. It's really getting to a point where you can diversify and making sure that, if one bad thing happens, it doesn't wreck your entire retirement plan. Second item to consider when you're looking at different REITs is take a look at the management team. I think this is critically important. Make sure they have real estate expertise, make sure that they have been in the market, know what's going on in the real estate space. Real estate it's a great investment vehicle, but there's a lot of pitfalls that you have to be aware of as you get into investing. And, if you've got folks that have been involved, the management team has been involved with real estate for several years. That's a very important dynamic of looking at different REIT stocks. And then lastly, you really need to take a look at the financials. A lot of the public REITs, their financial information is publicly out on the SEC.gov. You got to take a look at, and there's also different quarterly communications that come through, quarterly dividends. The things you need to look at is look at net asset value trends. Has the REIT continued to appreciate in value, which is a component of what you end up getting, dividends paid out on. Look to see if they have cash on hand to make those dividends. Look at their dividend history. Look at how they've paid dividends over the years. Have they been increasing? Have they been decreasing? Those are all important. Look at the fees that are getting charged to the REITs and ensure that they're not excessive, and burdensome to the actual REIT. Investment philosophy is important, kind of going back to your investment objectives. What you like your investment to be diversified through? Is it residential? Is it commercial? There's a lot of different REITs out there with different opportunities for investments. Debt structure is another key component, making sure that a REIT doesn't have substantial amount of debt coming do, in the near term? And if they do, have they shown an ability to refinance debt over the years? And then lastly, redemption is if you get in a bind and you need to get your money back from the REIT, look to see what their redemption policies are. I mean, REITs are all over the board where it comes to redemption. Some allow them, some don't. Some allow them, but you have to hold it for a period of time. So, I think that's critically important as well, is it gives you the ability to exit if need be, if a certain circumstance may come up. So a lot to think about, but, just trying to, provide some information as you think about, diversifying your investments and looking at different REIT opportunities.
Awesome. Thanks, Brian. That's huge. And I really appreciate you being on, because I could not have done that part. So thank you. All right. So kind of moving to our next section, there's a big difference here between public REITs, which you can buy as a stock ticker, and privately held REITs. And so I just thought we'd lay out some pros and cons. Public REITs, very liquid. You can trade them just like stocks, right? You have a lot of oversight from transparency. So you got a lot of regulation around that. Usually these are very large, very diversified, large track records, good history, all that good stuff. And then accessible, right? Like you can go in and you can usually invest very, very little and be able to participate, which is great. On the private side, you usually are going to see higher returns on that private REIT, mostly because they don't have all these, there's not all the legal costs and all the sunk costs that happen of carrying a big ship. And so potentially you'll see higher returns. You don't see as much volatility over in that private sector, increased control in terms of the manager having some control over where things are going. And typically, the lower fees do occur here as well. So very interesting to kind of look at the pros and cons there, or the pros. We'll look at the cons, right? In my opinion, this first one is the biggest con in terms of if you're investing in a public REIT, which is typically these REITs do move with market and based on perception of their value, versus the privately held REITs that are moving typically right off of the assets held in the value of the actual fund. So it's just something to think about, right? Public REITs are kind of having a little bit more of a short-term focus. They don't have as much control over value and that sort of thing. And you'll see a lot of fees in those public REITs. And I think it's important to note that it's not that you see fees every day. You see fees based on they're already taken out, right, before your distribution comes to you. So that's kind of the thing to look at. In the private sector, on these private REITs, what you're finding is there's a lack of liquidity in a lot of points. It's a higher entry point, so you're not usually able to just go in at a lower value amount. And you're also looking at a much longer value horizon, if that makes sense. So lots of those things occur, and the comparisons right there for us to look back at as we go. So, all right. So we wanted to lay out a few of our favorites here in terms of which one to look at and just compare when we're looking at these different REITs and these different opportunities. Here we go. So obviously we put REITs in that left-hand column. We got Yield Street, Blackstone, Fundrise. Everybody might be familiar with these. These are all private REITs, and they're great to kind of compare and look at. And honestly, they'd probably be a good bucket to look at if you're looking to diversify across all of them, right? So in the REITs bucket, minimum investment's $100. The annualized return since inception is what we're looking at here, has been slightly over 18% at REITs. The fee is a $5 fee when you make your first transaction. And in social impact, every resident is an investor over there at REITs. Yield Street, amazing platform. I don't know if anybody's played around on there. Their tech is awesome. They do have a $10,000 minimum investment. Their annualized return, they've done well, 9.5%. They have a 2% management and operations fee, and there's no real social impact if that's important to you. Moving into Blackstone, I think everybody knows this name. The unique thing about Blackstone is what I would say is this minimum investment. So if you take a look, and this is kind of popular when you look at some of the REITs structures out there, but there might be a different class of stock given to people who put $1 million in versus given to people who put $2,500 in. And when you're looking at what REIT to invest in, that's something to pay attention to, right? Look at what those minimums are and look at there's different payouts for stocks and different options. So I thought we would point that out. One of them is the class one is $1 million investment, and then class S, T, and D are a $2,500 minimum. They've done well since inception as well. They have a long track record of doing really well at just slightly under 12%. You will see some fees in there, 1.25 for the NAV, and plus an annual return fee, which is a hurdle fee and a carry cost. Honestly, some of those things get pretty complicated, and you should definitely start to research into how that looks. And it's mostly waterfall driven and performance driven. So definitely a REIT to take a peek at. And on the far right here, this is Fundrise. Fundrise is really cool, great platform. Their annualized return has been around 5% since inception. And they do have some fee structure there as well, with an advisory fee coming off and a annual investment fee that comes off as well. Real quick, I forgot to touch on this, but I think it's important. Roots focuses in on the single family asset class. Yield Street is in the commercial space. So a lot of really cool big buildings you can be a part of on that one. Blackstone is kind of blended multifamily, single family, and commercial. Fundrise is primarily larger multifamily. So again, check them all out. Definitely worth a peek. And these are some good options if you're looking to invest. All right. Now, as I mentioned, we are going to do some self-promotion, let everybody know a little bit more about Roots and what we're about. And this is our core. This is our why. We actually believe that location is super important when picking out your property, but the location could be overlooked when you think about it as the people who actually live in that home and rent that home are actually who determine your return on a cash flow basis, on an annual basis. Location's important, right? You know, that appreciation of that property is going to happen whether you leave it empty or not. But really what's core to the success of any investment, and in my personal opinion, what's core to the success of like our society, is to give the people who are renting your place and are to be a part of this. And they're a huge attribute to the success of any investment. So people first, and they are very important to why we built this REIT. Awesome. The other benefits that we provide from a REIT standpoint are our liquidity factor. So at Roots, you can cash out quarterly. We give that opportunity to all of our investors. There are limits to it, 5% of the fund and other things. So check the fine print. But in a real world scenario, we have never had to say no to a liquidity opportunity, and we've been able to cash every investor who wanted out within 7 days. Tax advantages, we went through this, but the same apply for us. Dividends, we've paid a dividend each quarter that we've been around, and we plan to continue that trend. Diversification, we've talked about this, guys. We are diversified across the Atlanta region and look to move out into other target markets pretty soon. This is our current fund traction. We've been around for 2 years now, a little over 2 years. We have 53 properties. The property value of just the properties in the fund is slightly over $18 million. The fund, since inception of July of 21, is up over 36%. We have raised a little over $15 million at this point, and we have actually over 1,400 investors into the fund. So every day our number grows, and we're excited to have all of you guys that are investors on this call. Thank you. And then, something that's really important to us is the resident impact. And since starting the fund, our residents have saved and invested over $272,000. So kudos to any residents if you're on this call, and thank you guys for being a part of this journey with us. All right, we're going to do some REIT review questions, and hopefully we can answer everything and get to everybody. Thank you guys for joining us. I'll ask Scott Jacobson, one of our co-founders, to hop on and ask the questions and moderate with us.
Hey, thank you all so much for joining. Nice work, Daniel and Brian. We've been answering a lot of the questions directly into the chat. So there's about 11 open right now. I'm going to either spit them off and answer them or pass them over to one of you guys, Brian and Daniel. The first one from Joe Richards: is there info provided for REITs for future housing units growth to be acquired, projected growth? If yes, do investors have this info provided through an investor portal or monthly/quarterly updates?
I'll take this one. So to wrap it up, yes. So we don't exactly give like voting rights in terms of what we're looking to buy or when future units are coming up, but we do, I would say, a great job of almost over communicating what we're buying, what we've been doing. And a big part of that is we do a quarterly webinar at the end of the quarter that wraps up what we bought, what the impact on the fund would be, any cool resident stories that we have, any big moments in the fund for the quarter get wrapped up in that webinar. And then that gets dispersed to our entire community. So yes, we do try and keep everybody as up to date as possible.
Sweet. Next question. Is there a ticker to look for and see costs and some material to see returns and longevity of the funds? I'll answer this. First of all, yes, you have an online portal to see how your returns are and how the fund is historically returning. Also, all of our filings are public information. There's a link to all of our SEC filings at the bottom of your investment portal. Everything is transparent, so you can see everything from there. We don't make forward-looking statements. We have target returns that we are looking to hit, but the historical returns are the best barometer. Daniel, anything you want to add to that?
Yeah, I'll just look and just making sure in case that wasn't just REITs or just a REITs question, you can always find like any public REIT information easily online on the SEC documentation and underneath their filings as well. So it's a good place to start to look for information on these funds. Privately held REITs that are not Reg A like ourselves or under any SEC guidelines in terms of that do not publish them often. So yes, depending on which REIT you're looking at, you'll have to kind of do a little digging typically.
Yeah, and I'd just add there that, the website for the SEC is www.sec.gov. And then there'll be an area where you can search company filings, and then you just type in REITs real estate investment and it'll pop right up. Or any other, REITs that you may be, looking to research.
Awesome. Thank you. All right, next question. What is the Atlanta real estate market like now? Are rents still rising? Are real estate values increasing or decreasing? What's the market outlook?
Yeah, that's a fantastic question, Thomas. Really, right now, we are at a very interesting time. Basically, what's happened is everything's pretty frozen, honestly. We appreciated 8% last year over the last 12 months. So technically, the market's still rising a little bit here. The main catalyst for that is these high interest rates have really got everybody who, if you don't have to sell, you're not selling is the key, right? You're not usually going to move from a 3% interest rate into a 7.5. It just doesn't make sense financially. And that's put a stranglehold on the inventory, which has kept our pricing high. And that's from a purchasing standpoint and like a value standpoint. From a rental standpoint, we are definitely not increasing at the 20% rate that we had over the last 3 years, which was insane anyway. And I think a lot because of greedy landlords, not because of actual increases that needed to happen. And so we're not seeing as much of an increase. We're in kind of a flat state in there too as well. So in my opinion, both of those are actually pretty good for the market here in Atlanta. So hopefully that answers the question.
Yep.
Yeah, I'd say one thing too, just the Atlanta market being as large as it is and continuing, more people continue to move to Atlanta every day. I mean, I've lived here for 15 years and 2 million people have moved here since I've moved here. And, that is going to drive the need for housing. And, there's eventually going to have to be more supply and continued, growth in the real estate space just to fulfill, personal needs of places to live.
Absolutely. Great point, Brian.
Awesome. Thank you, Brian. Is my capital protected? What if something happens to REITs?
Yeah. So, REITs is an investment. So no, there is no capital protection in terms of, that if something catastrophic happened in the REITs world or in the real estate world, yes, you could obviously potentially lose investment. I think the biggest thing to look at when you're looking at any REIT investment is there's actual hard assets there, right? So when you invest into a stock and there's a collapse of that stock, there's not usually assets to be sold off, right? It's the technology and the management team and all of that just went downhill. There's not really anything to collect, right? So even in the world of, hey, REITs for whatever reason didn't work or whatnot, there are assets, there's hard assets that company owns that would be sold and dispersed to the investors. So no, there is no capital protection plan per se, but you do have hard assets backing your investment.
Thank you. Is it better to invest as an individual or through my corporation?
I'll let you take that one, Brian.
Well, I think it really just depends on, what your tax structure is. And I think that's where you really have to get to the specifics of talking through it with your actual, financial advisor and or tax preparer, because each individual situation might be different.
Awesome. If I choose to reinvest the dividends, does it still count as a dividend payment? Example, is it an income / distributing or accumulating fund?
Yes. So I think there's a couple questions in that vein. So yes, unfortunately, if you get a dividend payment, whether you choose to reinvest it or you choose to take it off the table, you will see a taxable event on your 1099. To Brian's point earlier, you're going to see you should, and talk to your CPA about how to make it work, but you should see a deduction on that income of 20%. I'll say from a REIT standpoint, what we give the opportunity to all of our investors who want to reinvest their distributions. We let them do it at the previous quarter's price. So for example, a lot of our investors, about 86% of them, decided to reinvest last quarter or this quarter. And that was probably because one, they get to compound the interest, obviously, but two, they also got to invest at 120 a unit instead of what it currently is, which is 124. So there are some different levers that are, kind of balance that act out. But unfortunately, yes, you do see on the 1099, you'll see a income there.
Thank you.
Anything you want to add on that side?
No, I think that was right on point. I mean, unfortunately, a taxable event is a taxable event.
Yep. And that goes in. This was the next question. If all distributions are regularly reinvested, is a taxable event avoided until the sale of the REIT shares?
It would be taxable income at the point that the dividends are declared.
Thank you. All right. Let's see, this might be the same question. From a tax liability perspective, I would assume tax liability. Okay, yeah, same question. This was just answered, so I'm going to move to the next. Is this correct? Invest 10K. When I sell, this 10K is not taxable. I've gained 5K in appreciation. Dividends declared. I'm a little lost on this question.
Let me read it and let me just see here. All right. Yeah. So the question is, there's a couple questions here, right? So the first question is, if I put 10K in, am I ever going to be taxed on that money? The answer is no. You will not be taxed on the 10K. You already hopefully paid taxes on it. When you take that out and there's a sale, that will be your basis and it will not be taxed.
That's the return of capital that I mentioned earlier in the discussion.
Yep. So we return that capital. And then at that point of the sale, whatever the appreciation is, call it 5K in that example, that would go under long-term capital gains taxed at whatever that current rate might be. So definitely keep your eyes on what that capital gains rate is at the point of sale, and maybe wait 4 years, as it kind of tends to change every 4 years.
Depending on who's in office, right?
Yeah, exactly.
Thank you. In the REIT comparison graph, the other REITs have been around a lot longer. The 18% plus for REITs is based on a mere 2 years. Typically, wouldn't the annual returns be lower going forward? Please address what can reasonably be expected.
Yeah, absolutely. So our target rate for the return of the whole fund, our target's always been between 13 and 15% annually. And yeah, over the last 2 years, we've knocked it out of the park. And I think when you look at REITs, that's a good factor to look at, right? Go find yourself. Well, I do. That's how I look at it, right? If I can go find myself a place to get in earlier in that curve, I'm going to do it, right? And so, yeah, we are on an upward trend. And, I think within reason, over the next 5 years or so, as we continue, you'll see our returns kind of level into that 13 to 15 target percent. But until then, we're still growing rapidly, and we're excited about it. So great point. I do always start every call I get on with, don't expect 18%. If we can, that's exciting, and we'd love to do it. But yeah, I think everybody'd be happy with 13 as well.
What's your timeline and target markets for expanding your portfolio?
Good question. We don't have a timeline. If we found a deal today in Nashville, Tennessee, or Raleigh, North Carolina, or one of our other Southeastern target markets that worked for the fund, we would buy it. We have not found that deal yet, and we have not expanded yet because there hasn't been an opportunity that we found that was better than the Atlanta opportunity. As Brian mentioned, this city has a lot going for it. It is well known as one of the best real estate markets in the country. BlackRock has I think it's their second highest holdings in Atlanta. So all the big guys are coming here. We just happen to be here and start out here, which call it luck. But that's, we'll be here until we find an opportunity that makes us leave, and that we're excited about. So if you have opportunities out there, definitely send them our way.
Absolutely. Next question. What is the vetting slash qualification process for tenants for the houses? I'd be happy to take that.
All right, Scott.
Yeah, so there's a mix. Sometimes we buy properties that have residents in place, and in which case we bring them on board and keep them on board, assuming they want to stay there. And then when we have new properties that we're listing, we list them through the normal channels, all the listing sites. And we have a team in-house, our own team. We don't utilize third parties to field all the calls, talk to all the prospects, explain the program of how they'll be building wealth. It's important to us that that's explained early. It's obviously a differentiator and something that people really get excited by when hearing, as a bonus to finding a place to live. And then they have to apply where there's, background and screening done, but assuming they check our criteria, which is one that likes to work with people as much as possible and reasonable, then we bring them on board, we onboard them, and they become investors the day they move in. Next question. What are the restrictions regarding redemption? Can you cash out completely? I can take this one too, if you want. You can, first of all, you can take your money out quarterly. There's a cap to that. No more than 5% of the total fund can be withdrawn in a quarter. In terms of restrictions, there are none. If you take your money out within the first, other than the 5% I mentioned, if you take your money out within your first year of investing, there is a 6% exit fee. But as long as your investment is in for 12 months or longer, there are no fees whatsoever. And that's one of the cool features of our fund. Now, if you're talking about funds and REITs in general, it totally depends on that fund and how they structure. Each one has different rules and guidelines. And Brian, if you want to chime in, feel free.
Yeah, I would just say that, some funds don't allow them at all. And then, or there's it could be a significant period of time before they do allow them. So every one of them is different that I've seen. So I don't think there's one fits all, but that's kind of going back to the REIT's financials and reviewing what those criteria are and making sure as you're looking at investment options that if that's something that's important to you, that you make sure you look at that for each one that you're investigating.
Perfect. Thank you. Retired, looking for passive income. If I invest 10K, what kind of return should I expect realistically in a year?
I'll take this one. Congrats on being retired, Sue. But I think the component here is one, I want to make sure obviously we never send forward-looking statements. Previously and historically over the last 12 months, that's been roughly around a 5.5% cash distribution via dividends when it's annualized. So, if you wanted to do the math at around 5% of 10K, maybe that's a bar you could set or a target you could set.
Awesome. Thank you. How do I exit the REIT? Does the fund have a predetermined end date, or can I sell my shares on an open market?
So our fund's an open-ended fund. You don't sell it on an open market. You sell your shares back to the company and we buy them back. That's in order to control pricing and all those things. So with us, you log onto your REITs platform, you hit cash me out, and you tell us how much you want to cash out, and we buy those shares back from you at the current unit price.
Awesome. Thank you.
And that unit price is usually changes each quarter, right, Daniel?
Correct. Yes. Yep. So we change things quarterly.
Awesome. We got about 13 minutes. Questions are flowing. Do the $100 minimum go to only one property or more? The investment, whether it's 100 or whatever it is beyond that, is invested into the REIT as a whole. Therefore, it's essentially allocated equally across all the properties in the portfolio. And as properties are added, it continues to be reallocated. Let's see. Next question. Confused. 18 million with 53 properties. Are you holding a large amount of money, or does that represent investment in property?
So that is the 18 million is the fair market value of the properties overall. So the fund is actually calculated off the net asset value, which has a couple other factors for profitability, has a couple other factors in terms of what we're looking at. To answer the question of, are we holding a large sum of capital? We are not. We like to deploy our capital and not hold it to bolster returns.
Thank you. What's the percent borrowing leverage that you have on your rental properties, and at what interest percentage are your mortgages? Do you plan to refinance as rates are projected to drop?
Good question. So right now, our overall fund, the 53 properties we have in there. Oh, where'd it go? Never mind. I'll answer. The overall leverage on the properties is 58% loan to value. That is pretty conservative for a REIT. I don't think I've seen any that have that low of a debt qualifier on them. But so we are very conservative in terms of putting debt on. I think there was a tidbit there about what the rates were. Our rates, they vary depending on when we put the loan on. So we have, 17 of our properties at a 4.3% rate. We won't be refinancing that. We have another grouping at like 5.4. It really is a blended rate at this point. What I will say is we are not right now looking to put on long-term debt, right? Because we are in a high rate environment. So we have some short-term debt partners that we utilize, and in the hopes that, in the next 12 months or so, we get some relief on that side of the ball. And we can refinance and lower those rates for everybody.
Yeah, I think having that loan to value that low provides that opportunity, obviously, in the debt space. So I think that gives you the opportunity to refinance when that hopefully those interest rates do come down.
Thank you. What's the exit strategy for the properties you purchase? Is it buy and hold forever, a specific target date, as long as it's profitable?
Yeah, it's a fantastic question, David. For us, we are in kind of the single family space, which means that there's less than 5 units typically at our properties. It's scattered sites, so we're spread out across the metro area right now. And it's really property by property. It's looking at what that area is doing, how that area is appreciating. Did it hit its, is it plateaued a little bit? Is it a good time to sell? I mean, I think our overall fund strategy at the moment is to collect doors, right? We want to get to a space, we're at 100 doors now with those 53 properties. When we get up into the 200, 300 door range, we might start to look at, hey, does it make sense to sell a property now or not? I will say we did sell one last quarter. We had a incident at a house that we had in Marietta, Georgia. If you're familiar with that area, a resident of ours pointed out some mold and we had to fix it. We moved them into another property. By the time we looked at all the fixes and all the things, it made more sense to flip the property and give the profit to the investors than it did to continue to hold it as a rental. So that's what we did. So the fund profited about 30 grand off that property last quarter and in about a 6-month time. So it worked out really well for everybody. And we'll always look at opportunities as they arise and kind of go from there. So really case by case, but overall looking to collect doors, not lose them.
Perfect. How do you determine appreciation? Only when a property is sold? And if so, do you anticipate selling properties with some regularity?
So yeah, before a property enters into our fund, we have a third party appraisal done, whether that be a third party that is hired out by the fund or a bank appraisal when we're getting a loan. And that's the benchmark, and that's how we do it. After the property's been in for a year or so, we might do a desk appraisal or reappraise it if we feel like the number has moved a lot. But no, again, going back to that selling property, we do not plan to sell a lot of properties. No.
Thank you. Next question. Oops, sorry. Do you foresee increases in the distributions with the REIT, assuming growing rental rates and/or decreasing mortgage interest rates?
So for us specifically, I do anticipate that, and more like setting aside rent increases and mortgage rates decreasing, we are constantly adding more doors. And so when you add more doors, you have more rental income coming in the door. And so for us, it's more about we're just in that growth state where we are kind of going to see, hopefully, some of those distributions continue to climb.
Awesome. Is REIT investment collateralized by property?
So yes, to state it plainly, I guess you're investing into the company who owns the property. So yes, I guess your investment is collateralized against the property, but your name is not on a title of any sort.
Cool. Next question. The tiny home community is becoming very popular in many states with investors and builders alike. Do you plan to enter this market in any capacity? I'll take that. Plan, I don't know. We haven't written strong plans on it. However, absolutely. We are always looking to buy any different asset classes to keep our portfolio diverse. And as long as they're hitting the benchmark returns that we have, we will certainly explore purchasing. Next question. I don't know what this is referring to, Andrew. I'm really sorry, but it says, isn't that high for what I consider to be distressed properties? Am I wrong that you don't focus on distressed properties?
You are correct. We do not focus on distressed properties.
Correct. The fund is purchasing
rented properties.
Yeah, rented, exactly. All right. Next question. How are dividends that are reinvested taxed if the REIT's investment came in through an IRA?
I think, well, depending on what type of IRA, I think has an impact. Certain investments are taxable through the IRA and certain aren't. So I think that'd be a more specific question for your tax advisor on that one.
All right, thank you. Can I 1031 my investment into REITs?
No, gosh, I wish you could, Phil. This is a very popular question, and I hope to one day be able to say yes to it.
Your REIT net asset value growing every quarter and year. Do you attribute this to constant addition of properties or cost controls management, combination, etc.?
I think at this point for us, it's the consistent addition of properties. And more to that fact is it's our very disciplined approach to what we buy. We are not a fund out here buying 1,000 houses a month. We are a fund that is very picky in terms of the asset that we bring into the door. And I think that's what sets us apart in a lot of ways is we don't have, $20 million that we need to required to deploy tomorrow, right? We are very choosy with our assets and where we pick them.
Thank you. You didn't seem to touch much on the social mission, but what are current tenants seeing as far as financial growth for themselves?
Yeah. So Robert, good question. Our residents, their financial growth is the same as yours would be, right? When you put all their returns are the same as every other returning investment in our fund. And that's what makes us a unique opportunity, right? The only difference for them is, and I'll kind of speak to this, right? So just across the board, the average renter in Georgia and across the United States, I believe, has less than $650 in savings on average. Our residents on average have a little over $2,500 in their accounts right now. So just taking it off of, averages and where they're looking, this is a big moment and a big thing for them to be able to have this nest egg to lean on when needed. So that's kind of where they're at.
Awesome. Thank you. Boom. All right. Is your growth strategy targeted at just Southeastern market? Do you manage the rental homes in your portfolio?
Yes, we are targeting the Southeastern market at this point. I think we will stay there. I don't ever say we'll never go other places because, again, if an opportunity arises and we feel like it's a good thing for our investors and our fund, we'll do it. We're partially self-managed and partially not. We have about a third of our portfolio that's managed by a third party, and we have a bigger chunk that we manage in-house. And it really just depends on where we're going and what we're doing. So it's a blend.
Cool. Do you have an anticipated exit strategy / major liquidity event for the REIT, such as either looking to get acquired, etc.?
Not at this time. We do not have, hopes of being a public offering. Again, I believe that the crux of the public offering is that you are you're basing your value at that point. You're putting it in the hands of the people, and it's public opinion versus what's actually in the REIT. I wish people did do a lot of research and that it still functioned the way that a private REIT does, but it doesn't. So that's not in the cards. Well, it's not in the cards right now. And honestly, getting acquired isn't on the table at this point either. We love our residents, and the acquirer would have to prove that they could maintain this love for them and this engagement. So
awesome. We're at 1 on the dot. We got 5 questions left, so we're just going to try to finish these out. I believe the question's already been answered regarding if everything went south, and how that would work. So we'll move on from that. Hopefully you got clarity. If not, reach out to us. Would love to schedule a one-on-one. Do you work with more than one bank or mortgage company for your financing needs?
yes, we do.
Thank you. Typically, how old are the properties that the REIT holds? Are you foreseeing a lot of renovations or maintenance?
Typically, again, as we add assets, the age always is a moving target. We try not to buy properties that we foresee a ton of headaches with, obviously. And when we do buy properties, we have a unique mechanism of them already being rented when they come into the fund. And we have a sponsoring company that does a warranty for all maintenance and repair requirements. And so that money is a flat fee for the REITs fund. So there's not variable costs in the maintenance and repairs column that you see in other REITs.
Awesome. 2 more. When you exit the REIT, are you able to roll this type of fund into another less tax fund?
Michael, I don't know the answer to that one, but I'd love to pick your brain on it. I love the idea of less taxed funds. I just don't know what they look like. So maybe Brian knows.
Yeah, I'm not aware.
Cool.
Check with your financial advisor on that one.
Yeah.
Then the last question, being choosy to use your words, how does a target property belonging to an HOA affect your purchase decision, if at all? I'll take that. We, of course, do thorough due diligence on every property we're looking to buy. If it's in an HOA, we're going to make sure we understand all the guidelines and rules, including leasing rules within that HOA. And if it makes sense, we'll move forward. We don't mind being a part of an HOA. In fact, it can be very beneficial. And if there's things that we wouldn't break any rules, you know, you're not allowed to rent here due to the HOA rules, we're not going to buy there because it doesn't fit our criteria, but it's not going to steer us away if everything fits. That's it.
Absolutely. All right. Thanks for joining, everybody. Thanks for sticking around a little bit over time. Brian, thank you so much for being
Absolutely.
with us here. This was awesome.
Have a great day, everybody.
Thanks.
Thank you.